But the main thing here is to show you guys the power of this product. And if you guys are looking to get into the real estate game and you're looking to kind of house hack your way to that monthly cash flow, taking advantage of this property is going to extend your affordability much greater than what you would be able to get in at any other type of product out there on the lender market.
What is up, YouTube? Matt McKeever here, and in today's video we catch up with Josh and Aaron from the Findlay Mortgage Team, and they're going to break down for us a really innovative, interesting product that if you're an entrepreneur, if you're someone with a lot of money but maybe not a lot of income and you're looking to buy a house, a personal residence that's maybe a little bit outside of what most people would assume you could qualify for, well, they've got a really innovative strategy they're calling the Great Canadian House Hack. And in today's video, what they're going to break down for you is how you can get your hands on $1 million property with a 20% down payment while only making, say, $25,000. Now, I think most people would just assume that this was physically impossible, but it's great to know that there's some really innovative strategies for us, because as an entrepreneur, oftentimes we're not making a lot of money personally. In fact, we're often keeping all of our profits in our corporation so we can double down and try and grow that business, make it bigger. Because if you're in the growth phase of your business, you don't want to be pulling money out, but maybe it's time that you leveled up your principal residence, and that's what today's video is all about.
Hey guys, Josh and Aaron from the Findlay Mortgage Team, and in today's video we're going to talk about the Great House Hack. Now, we have clients who come to us all the time who are self-employed, who have a ton of down payment but don't show a whole lot in income. So we found a way between our lending partners to be able to get you guys into $1 million home with just showing $25,000. We're really excited to share it with you guys, so let's dive in. Hey guys, it's really important to note that when we say the word hack, we're actually trying to talk about the amount of income and utilizing the amount of income that you get from the property and using it towards helping you with your qualifications. So something really important about this specific product is it's a B product, meaning instead of taking the income and adding it to your gross income, we're actually using 100% of the rental income right towards the liabilities, meaning the entire cost of the mortgage and the property taxes and the heat are going to be offset by having other people live in the property. Now, this only works for a residential property, meaning a fourplex, and it has to be uninsured. Aaron's going to walk you through what it looks like.
Yeah, so we're gonna have an example posted up on the screen here, guys. First thing taking a look is we got Johnny the investor. He's making $25,000 a year. If you look down onto the bottom here, you're gonna see a couple things in this first graphic. The biggest one is going to be the rental income offset of negative $55,200. So that is, I think it was $4,600 a month for 3 units. We're using a fourplex example here. So you take that $4,600 multiplied by 12, that's going to give you your $55,200 for the year. We can now take that and offset all expenses that is on this application. Let's take a look. We have $10,000 a year in property taxes, $1,800 a year in heating, total mortgage payments for the year, $51,164.28. And the other expenses here, the $3,600 a year, that's going to be for car payment. Again, taking a look at the offsetting 100% of the rent, you take a look at that last line there, total expenses. This borrower is now only qualifying with $11,364 in total expenses on the application, down from, I think if you add them all up, it's around $66,000.
As you guys can see, the cost associated with actually purchasing this property and owning this property is significantly more than what the actual total income on the application is. So if you take a look at this and you actually look at the total rental income offset compared to the total income, it actually makes sense that somebody who's making $25,000 a year can afford, $11,000 in expenses. Whereas the other way around, if you had all these expenses, there's no way a bank would be able to give you a loan that was 4 times what you'd actually be making. Let's scroll down to the next example with the add back. So what we wanted to do is we wanted to show you the difference between what it would look like if you actually use 100% offset and what it would look like if you just use the add back. Aaron's going to walk you through this.
Yeah, guys, so on the A side, an A lender doesn't use or doesn't often use an offset. Some of the larger end banks may allow you to if the property comes in a certain debt ratio, but the majority of them just simply use an add back. So what does that mean? They just take what your rent is at a certain percent, and in this example, we're using 100%. So they take all the rent and add it directly onto your income qualification lines, and we are not offsetting any of the other costs. So a couple of things to look for. Total income. We've added $55,200 into the income, and this applicant is now qualifying with $80,200 of income. Further down there, you can see again, total expenses, $66,564. So we have greater income than what are the total liabilities for the year. But again, we can see that this client doesn't actually qualify. At the top there, it says the total debt service ratio of 82.99 was calculated. So that means the TDS ratios are 82.9%. That's way above what even a B lender is going to allow you to use to help qualify. So we just have an example of how particular and how awesome the B lender product is to be able to allow you to actually offset the cost and reduce your overall expenses versus just even adding back 100% of that rent. Even though you're adding an additional $55,000 of income a year, still can't qualify to get in on that $1 million property.
We just wanted to basically create a baseline example of what somebody could possibly qualify for making $25,000. We wanted to break it down to show you that even at $25,000 on the insured side, you won't qualify for anything. As you can see in the last chart here, Mr. Johnny Investor, he makes $25,000 a year. He's still trying to purchase this. He's trying to purchase this house here for $150,000. As you and I both know, you can't really purchase anything for $150,000. So the property taxes are $2,000 a year. He's got his heating costs, his first mortgage payment of roughly $10,000 a year, and he's like everybody else, has some payments, so he's got about $3,600 a year in payments as well. He's got a total expenses of $17,531. Now, if he came to us and he was like, guys, I want a mortgage, we'd plunk all these numbers into our calculation and we'd let him know that his TDS is actually 70%, which means there is no possible way any lender is going to be giving this guy a mortgage. The important aspect to really understand here is the power of offset versus add back. If you guys want to take advantage of this product and you're in a situation where you work for yourself and you maybe write your income down to a point where it's not going to allow you to qualify for the home that you're looking for, it's important to understand that if you're purchasing an owner-occupied multifamily property, you can use the rent that's being created from this property to your advantage to be able to help either grow your real estate portfolio or help you get into a property that you otherwise couldn't afford on paper.
The other property details that we're using, property taxes for the year, we're estimating at $10,000. Heating cost, the standard heating cost for a residential property is $150 a month. That's what we use on our application, so that's what we've used here. Total mortgage payments for the year come out to be $51,164.28. If you want to know what that is monthly, you can just take that number, divide it by 12, and that's going to give you your monthly mortgage payment.
Aaron, at what rate and amortization is that at, Eric?
This is at a 35-year amortization, which you can do at the B on the B side, and because it is an owner-occupied purchase, your interest rate is going to be somewhere between 3.5 to 3.8%. We understand that some of these things can change. Obviously, your property taxes can differ per property. But the main thing here is to show you guys the power of this product. And if you guys are looking to get into the real estate game and you're looking to kind of house hack your way to that monthly cash flow, taking advantage of this property is going to extend your affordability much greater than what you would be able to get in at any other type of product out there on the lender market. Again, this does on the B side, so there are some additional upfront fees. There are going to be your 1% lender fee and your 1% broker fee and your legals, as well as an appraisal at $450. But again, just in terms of being able to get into a product and a property that you aren't able to with a lower end salary, this product really opens up your affordability.
Yeah, guys, again, if you have any questions, please feel free to leave it in the comments below. If you haven't already, please hit the like button, hit the subscribe button on our YouTube and Instagram channel. We'd be happy to have you guys following us so we can push out more content.
Thanks, guys.
Thanks again to Josh and Aaron for bringing this video and this entire idea to the channel. I would have never even thought that something like this was possible, but it's great to hear some of the unique strategies and products their B lenders are bringing to them because, hey, These guys are constantly dealing with real estate investors, so they understand the pain in the ass we are and all the complications we usually bring to the sort of deals or transactions we're trying to do. So I really do appreciate Josh and Aaron. So if you guys haven't already done so, make sure you jump over to their YouTube channel, give them a subscribe, check out their amazing content, because if you didn't know, every Friday they're on my channel, but right after my channel, they go live on their own YouTube channel to answer any of the questions you may have on the video you just saw.